An estate account is an account that maintains estate assets pending the conclusion of the estate administration process. Typically, the initial funding of the estate account comes from existing accounts that were owned in the decedent's individual name. This could include things like checking accounts, savings accounts, investment assets, potentially money market funds or certificates of deposit. And then once assets in the estate, like real estate or personal property, are liquidated, the proceeds from those sales are also deposited into the account. When a person dies, there are very often bills that need to be paid. So these could include medical bills, it could be personal bills, bills, for example, that are related to homeownership. So gas, electric, cable, internet, trash, sewer, water. Maybe there are judgments against the decedent that need to be paid, or credit card balances. Or if the funeral bill, if arrangements were not prepaid in advance by the decedent, that would be paid out of the estate. Taxes are also paid out of the estate. So in Pennsylvania, where I practice, this very often includes Pennsylvania inheritance tax. Eventually, the beneficiaries are also paid out of this account, which could happen in different ways. Occasionally, the estate will make an advanced distribution to beneficiaries, but this does not happen in every estate. The executor has to analyze whether making an advanced distribution could potentially jeopardize an efficient administration of the estate going forward. So if, for example, a distribution is made, what happens if a claim comes in later that wasn't expected? How easy or difficult will it be for the executor to pull back that money that was already distributed to the beneficiaries? Personally, I think it's wise to make a presumption that once that money goes out, it's going to be incredibly difficult, if not impossible, to get back. You also want to make sure that there are enough funds retained in the account to pay fees and costs. If there's any contention between beneficiaries or between the executor and beneficiaries, I generally do not recommend making a sizable advanced distribution. In that situation, we generally recommend holding assets in the estate until the beneficiaries sign a release, which effectively consents to the accounting of the estate and serves as a waiver against claims stemming from the executor's service to the estate. In high interest environments where you expect the estate to hold estate assets for a long period of time in that estate account, it's arguably irresponsible not to try to generate some return on that money pending final distribution to the beneficiaries. This is not, however, always an easy decision. Depending on the estate, there's a lot that goes into reporting income. So any income that's generated to the estate is called fiduciary accounting income, and it must be reported to the IRS in Form 1041, and in Pennsylvania, it must be reported to the Pennsylvania Department of Revenue in Form PA 41, but it's not as simple as just reporting the income. Whether or how to distribute income to the beneficiaries can add to the complexity of making this determination. There are a lot of nuances and factors that need to be carefully considered. So the executor, hopefully with the advice and guidance of a good estate attorney, will undergo a careful analysis to determine whether moving assets into a certificate of deposit or treasury bills or some type of an interest-bearing account is the best strategy. Please consider subscribing to the channel if you find this content useful, and I hope to see you in the next episode.